Welcome to Talk Tickers. Today, we're breaking down the Toro Company's fourth quarter 2025 earnings call, and this was a report that sent some seriously mixed signals to the market.
Okay, so let's dive right into this. On the morning of December 17th, Toro drops its earnings report and boom, the stock just rockets up. It closed the day with a massive 10.7% gain. You know, in a market that's been pretty choppy, a double-digit pop like that is a huge deal. Well, not quite, because just one day later, some of that big gain, it just faded away. So in this explainer, we're going to break down the numbers that caused that initial pop, the strategy management is executing on, and the debate that is clearly still unfolding in the market.
Let's start with the headline numbers that really sparked that rally. I mean, what did investors see that got them so excited?
It was a classic beat on both the top and bottom lines. Toro delivered adjusted earnings per share of 91 cents, which was a solid 5-cent beat over what analysts were expecting. And then you look at revenue. Came in at $1.07 billion. That's nearly $21 million ahead of expectations. Now, it's worth pointing out that revenue was actually down just a little bit year over year, but hey, in a challenging economy like this one, beating estimates is the name of the game. And that's exactly what Toro did.
To put it simply, this 5.8% earnings beat, this was the catalyst. This is what ignited all that investor optimism. It sent a really clear signal that despite a tough macro environment, the company was executing at a much higher level than Wall Street had given them credit for.
But you and I both know the headline numbers only ever tell part of the story. To really get what's going on here, we have to look under the hood at management's actual strategy for getting through this tricky environment.
And what you see is a company with a real split personality. The professional business, which is their core engine, we're talking about 80% of the company, it showed incredible strength and resilience. A powerful 19.4% full-year margin. Wow. That's driven by steady demand from big projects like infrastructure and construction. But then, on the other hand, you have the consumer-facing residential segment, which is still struggling. Sales were down over 5% as homeowners are just being more cautious with their spending. And this quote right here from the CEO, Rick Olson, this is the narrative they just hammered home on the call. The theme was all about focusing inward on the things they can actually control, productivity, efficiency, costs, to try and offset those external pressures they can't do anything about. So, their main weapon in this fight? It's a program they call AMP, which stands for Amplifying Maximum Productivity. Basically, this is a massive internal restructuring initiative designed to make the company leaner, meaner, and way more profitable. And let's be really clear, AMP isn't just some corporate buzzword. This involves some concrete and, frankly, some pretty tough actions. As you can see, they're closing down facilities, they're shrinking their operational footprint by over 1 million square feet, and they've cut their salaried workforce by nearly 15%. This kind of internal discipline is a huge piece of the bull argument that drove that initial stock pop. And the results of this program are already starting to show. I mean, it's working so well that management has actually raised its annual run rate savings target from an initial $100 million to now an expected $125 million plus in savings by the end of fiscal 2026. But it's not just about cutting. They're also making some really smart, strategic acquisitions. The recent purchase of Tornado Infrastructure Technologies is all about doubling down on their strongest business, that professional segment. This move alone is expected to add about 2% to the company's total sales.
Okay, so we've got a solid beat and some really strong operational execution, which brings us right back to our first question. Why did that huge 10% stock pop start to fizzle out the very next day?
This timeline literally shows the market's debate happening in real time. You see a massive wave of buying on earnings day, pushing the stock from around $72 to over $80. Then the next day, a reversal. The market started to digest the full story, and you can bet some profit-taking set in. This slide really gets to the heart of the whole investor debate. It's like a tug of war. On one side, the bulls are pointing to the strong performance of the pro segment, record-breaking free cash flow, and just excellent execution on that AMP program. But on the other side, the bears are pointing to the ongoing weakness in the residential segment, coupled with some really significant tariff headwinds. It's a classic battle, strong internal execution versus some very challenging external factors. And this is the big number that's giving investors pause. Management is projecting that international trade tariffs are going to create a roughly $100 million headwind to their profitability in fiscal 2026. That is a significant cost to overcome, and it really raises the question of whether their productivity gains can fully offset this huge external pressure.
So, let's put it all together.
What's our verdict on Toro, and what should we all be watching for on the next earnings call?
Well, looking ahead, management is guiding for pretty modest growth. But the key story for the next quarter, for sure, is going to be that battle between their internal productivity gains and those external tariff costs. So the two crucial questions for investors are pretty simple. First, can their cost savings actually outpace the tariffs? And second, are we finally going to see some signs of life in that struggling residential segment?
So our call on this one is market perform. And here's why. The company is executing superbly on everything that's within its control. I mean, they're generating massive amounts of cash, they're improving margins through smart cost cutting. But those significant tariff headwinds and the ongoing weakness in the consumer business are probably going to act as a ceiling, capping the stock's upside, at least in the near term.
And now for our plausible trade. The company's cautious guidance is all based on a weak consumer. But what if that's wrong? What if we get a mild winter that pulls spring demand forward, and consumer confidence rebounds way faster than anyone expects? With all the operational leverage they've built, any surprise strength in that residential segment could send earnings soaring, turning this market performer into a sleeper outperformer that the market just isn't pricing in today.
This is not financial advice.